Welcome to the Singapore Market Digest for Friday, July 4th, 2025. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX, giving you the critical updates you need to stay on top of your game. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. What a day to be covering the Singapore market. The government just dropped some major property cooling measures that took effect today, and we're seeing immediate impacts across the board. This isn't just another minor adjustment. We're talking about significant changes that will reshape how people think about property investments in Singapore. Let's start with the bombshell news. Singapore's government announced major changes to the seller's stamp duty late yesterday night, and these measures are already in effect as of today. The authorities have increased the seller's stamp duty rates by 4 percentage points and extended the holding period from 3 to 4 years. This means if you buy a property today and want to sell it within the first year, you'll now pay 16% stamp duty instead of the previous 12%. That's a massive deterrent for speculators and short-term flippers. The timing couldn't be more strategic. Private home prices have been climbing steadily, with a 2.3% rise in the fourth quarter of 2024, marking the strongest quarterly growth of the year. The government clearly saw the writing on the wall and decided to act decisively. In their statement, they pointed out that the number of private residential property transactions with short holding periods has increased sharply, particularly in the subsale of uncompleted units. Now let's talk about how this affects our major property players. Frasers Property, trading under ticker TQ5, and UOL Group, under ticker U14, are right in the spotlight today. Both companies are major property developers, and they're feeling the immediate impact of these new measures. Frasers Property shares ended flat yesterday at 89.5 cents, while UOL Group actually dropped 1.2% to 6.62 before the news even broke. This shows that the market was already sensing some pressure in the property sector. Frasers Property has been on a strong run lately. They reported impressive growth with net profits soaring 147.6% year-on-year in the first half of 2025 to 142.2 million. Their revenue also jumped significantly, driven by strong sales from their residential projects and improved performance in their commercial portfolio. The company has been actively launching new projects, including their collaboration with Sekisui House on the Robertson Opus, a luxury development in District 9 with 348 units starting from $1.37 million for a 431 square foot suite. UOL Group, on the other hand, has been preparing for the launch of Upper House at Orchard Boulevard, with prices starting at $3,150 per square foot. That's premium pricing in a market that just became much less friendly to quick flippers. The irony is striking. These developers are launching high-end projects, right as the government makes it much more expensive to flip properties quickly. But here's where it gets interesting from an investment perspective. These measures might actually benefit established developers like Frasers Property and UOL in the long run. How? By reducing speculative demand, they could see more genuine buyers who plan to hold properties longer. This could lead to more stable sales patterns and potentially better margins, even if initial volumes might dip. The broader context is crucial here. Singapore's property market has been heating up, with private home prices rising 3.9% for the full year of 2024. While this is down from the 6.8% increase in 2023 and 8.6% in 2022, the government clearly wanted to prevent any acceleration. Sales of private homes moderated last year, falling by about 14% compared to the annual average volume from 2021 through 2023, but recent quarters showed signs of renewed activity. Minister for National Development Desmond Lee has been signaling for months that the government is ready to implement further cooling measures if necessary. In January, he made it clear that while they're waiting for previous measures to work their way through the market, they're not averse to putting in new measures to prevent property bubbles in both private and public housing sectors. Now let's shift gears to another significant development. QAF Limited, trading under ticker Q5F, dropped some disappointing news yesterday. The food manufacturer expects a material reduction in profit for the first half of 2025. Their shares closed flat at 91.5 cents before the announcement, but this could change as the market digests the news. QAF is dealing with a triple hit that many companies are facing right now. They're struggling with higher operating costs, unfavorable foreign exchange rates, and increased impairment of their joint venture investment. The silver lining is that their revenue for the first half of 2025 is expected to be comparable to the same period last year. This suggests the company is maintaining its market position despite the profit squeeze. This is particularly relevant for Singapore investors because QAF represents the challenges facing many local companies dealing with global supply chain pressures and currency volatility. When an established food company like QAF struggles with costs, it often signals broader inflationary pressures in the economy. The company has been working to diversify its operations and improve efficiency, but external factors are clearly taking a toll. The food and beverage sector in Singapore has been under pressure from multiple fronts. Rising commodity prices, labor shortages, and supply chain disruptions have all contributed to margin compression. QAF's situation reflects these broader industry challenges, and investors should watch how the company navigates these headwinds in the coming quarters. Looking at the broader market implications, today's developments highlight Singapore's ongoing balancing act. The property measures show the government is serious about keeping housing affordable for locals, even if it means potentially cooling investment activity. This is classic Singapore policy making, decisive, immediate, and designed to address specific problems before they become systemic issues. For retail investors, this creates both challenges and opportunities. Property stocks might see some near-term volatility as the market adjusts to the new reality. However, companies with strong fundamentals and diversified revenue streams are likely to weather this storm better than those heavily dependent on speculative activity. The key is to look beyond the headlines and focus on the underlying business strength. Frasers Property, for instance, has a diversified portfolio spanning residential, commercial, and hospitality properties across multiple markets. Their strong balance sheet and development pipeline position them well to navigate these changes. Similarly, UOL Group's integrated approach, combining property development with hotel operations and other businesses, provides some insulation from pure property market cycles. Their track record of successfully navigating previous cooling measures gives them credibility in managing through this latest round of changes. Here's my take on today's developments. The property cooling measures represent a classic Singapore policy move, decisive, immediate, and designed to address a specific problem. For retail investors, this creates both challenges and opportunities. The most crucial takeaway is not to panic about property stocks just because of these measures. Yes, transaction volumes might drop initially, but established developers with strong balance sheets like Frasers Property and UOL Group have weathered similar cycles before. The key is distinguishing between companies that rely on speculative flipping versus those with genuine development pipelines and rental income streams. Look for developers with strong pre-sales, diversified portfolios, and solid financial positions. These companies are more likely to emerge stronger from this period of adjustment. For QAF's situation, this reminds us why diversification matters across sectors. Food companies face different challenges than property developers, and having exposure across various industries helps smooth out these bumps. Today's movements underscore the importance of looking beyond short-term headlines and focusing on companies' fundamental business strength and management quality. The Singapore market continues to demonstrate its resilience and the government's commitment to maintaining stability. While these measures might create some short-term volatility, they're ultimately designed to ensure the long-term health of the property market and the broader economy. That's the scoop for the SGX today, July 4th, 2025. Navigating these daily market shifts is crucial for your wealth growth in Singapore. If you found this digest helpful and want to get my real-time analysis, urgent insights, and a daily heads up on crucial market movements delivered to you up to a week before anyone else sees them, then our premium membership is for you. It's just $1 a month, less than a cup of coffee. Think of it as your daily dose of market foresight directly from my desk. Ready to stay ahead in the Singapore market? Just click the link in the description below to become a member. See you tomorrow.